The growing Islamic finance market has helped economies diversify their investor base, said Director and Global Head of Islamic Finance at Standard & Poor's Mohamed Damak. Damak told Anadolu Agency there were new players in the market for sukuk, securities similar to bonds, which marked a significant and growing interest in Islamic finance. In 2014, we saw sukuk issued by the UK, Luxemburg and South Africa, Damak said. Why are these issuers doing that? Damak argued issuers outside the Gulf Cooperation Council and Asia chose to issue sukuk in order to attract investors from the Middle East and Asia, thereby diversify their investor base. For countries like the UK, Damak said it was more about setting a benchmark for private sector issuers and encouraging them to see sukuk, which is expected to hit $115 billion in 2015, as a complementary route of financing. We don't think there is a competition between Islamic banking and conventional banking or that any model is trying to take over the other. We think there is significant and growing interest in Islamic finance in several countries and that could be seen in recent sukuk transactions from non-traditional issuers, Damak said. 2/3 of sukuk issuance in Malaysia. Damak said some 2/3 of sukuk issuance came from Malaysia, which issued $50 billion worth of sukuk in 2014. But the Malaysian Central Bank has not issued any sukuk in 2015, which might result in a major slowdown of the sukuk market if this trend continued, according to Damak. Turkey contributed 3% of the total sukuk issuance, a rate that is growing with both the government and private financial institutions expressing more interest in the market, Damak said. Sukuk is the Arabic name commonly used in reference to what is regarded as an Islamic equivalent of bonds. But unlike bonds, it accrues no interest and hands partial ownership of a property, earning proportional rent for the buyer, who also accepts vulnerability to the risks involved.